Investing by lending your money is often seen as the most secure way to make passive income. Whether that's true or not, we will find out here. First, you might hear me use the phrases investing in lending and investing in credit instruments throughout this video. Just note that I will use them interchangeably. Second, we will discuss the two major investment types you can make by lending your money: peer-to-peer lending and bonds. While they're both classified as lending, just know that this is about the only thing they have in common. They are very different in terms of security and expected returns, and we will see the pros and cons of both. Lending money means that you put your capital at risk by giving it to someone else and expecting to be compensated for that risk in the form of interest. You negotiate a certain time period after which they will give you your initial money back. Until that time comes, your profit is made from the interest payments. Now that you know what lending is, let's dive into the two main ways you can invest by using it. The first one is peer-to-peer lending. Peer-to-peer, also known as P2P lending, is a way for people to lend and borrow money directly from each other without involving traditional banks. It's done through online platforms that connect borrowers who need money with investors willing to lend their cash for a return in the form of interest payments. It is also known as social lending or crowd lending. The activity has only been around since roughly 2005, but has been growing in popularity ever since. Peer-to-peer lenders are individual investors who are usually seeking better returns on their money than traditional lending instruments and are using those online platforms to connect with borrowers. These borrowers are individuals or small businesses looking for alternative ways to borrow money. Let's see what the pros and cons are. Starting with the advantages. The main one is that P2P lending offers higher interest rates for investors compared to traditional methods of lending money, like bonds or simply keeping money in the bank. And yes, saving money in the bank is lending, but that's a whole separate topic. So in short, your returns will likely be higher than if you are lending money to corporations or governments. Another advantage for the more do-it-yourself type of investor is that you can personally choose the types of people who will receive loans from you. The platforms allow you to invest in lending based on your risk tolerance. You can use their automatic matching capabilities and set parameters according to which they match you with borrowers. Or you can manually do it yourself. Now, going to the disadvantages. The first one is connected to the biggest advantage, which was higher returns, and that is higher risk. The two often go hand in hand in investing. You're basically lending money to unknown individuals or small businesses that usually can get very good terms from a traditional lending institution like a bank. Because of that, there is a lot higher risk of defaults, which means people not paying back the money you gave them. Research on P2P lending platforms has indicated that defaults there are much more common than those in traditional financial institutions, sometimes in excess of 10%. Another risk you have to be aware of is failure of the platform itself. It is important to use a reputable platform that is well regulated and has segregated accounts, meaning that they don't mix their money with their customers' money. If that rule has been kept, then you probably will still be owed your money from the borrower, but the service might be disrupted, you might have to wait for years, etc. It's not a pleasant process to go through. Alright, now let's talk about bonds. Bonds are a loan you give to a company or government. In return for your money, they promise to pay you back the original amount, called principal, after a certain period, which is called maturity date. Plus, they'll pay you fixed interest periodically, which is where your return comes from. It's a way to invest and get steady income through those interest payments, and then if the borrower does not go bankrupt, you get your original money back. However, something to remember is that you get your original money back at the same nominal value only if you wait for the maturity date. If you don't, then you will need to basically trade the bond at whatever the current price is. And since bonds are financial instruments which can be traded just like stocks, their price fluctuates every day. So if you have a $1,000 bond maturing in 5 years and you wait for 5 years, you get your $1,000 back. However, if you want to get your money on the third year, you might have to sell it for $800 at the open market. The main advantage of bonds is that it is the most secure form of passive income you can have. If you're lending to corporations, this is less secure than lending to governments, but it also depends on which government and which company. There are specific agencies whose job is to assign ratings that represent how likely is a company or a government to go bankrupt. So, for example, if you invest in a Microsoft bond, you are way less likely to lose your money than if you invest in an Argentinian bond. In general, however, if we try to compare apples to apples, corporations have at least a theoretical chance of going bankrupt, whereas a developed world government going bankrupt is highly unlikely. While that might sound good, it isn't. And I will talk about why in a second. First though, regarding corporations, the reason bonds are the most secure type of investment is because of something called capital stack. The capital stack is a way to visualize all different types of financing used for projects, ranked from the safest to the riskiest. It basically outlines who gets paid first. So imagine this, a company is worth $1 billion. It runs into financial trouble and goes bankrupt. As a result, it is liquidated. It owns $600 million to bond investors who lent it money. It pays back those $600 million in full. And then, with the rest of the $400 million, everyone else who invested in the company's stock gets paid proportionally to their shares. And it doesn't matter whether they get 100% or 1% of their original investment. The thing you need to remember is that bond investors get paid first. And then, whatever's left is distributed to the rest. And when it comes to government bonds, you are basically guaranteed to get paid back unless the government goes bankrupt. This is why the interest rates on bonds of third world countries is so much higher than those of, let's say, the USA or Australia, because they are riskier. However, if you invest in a bond of a country like Canada or Japan, you are basically guaranteed to get your money back. This is the main advantage, and at the same time, the main disadvantage, and exactly the reason why I don't own bonds. Confused? Let me explain. In order to explain that, I first briefly need to answer the question of what money is. This is a topic for at least an hour-long video, but I will try to give you the extremely simplified and ridiculously shortened version. You already know from this Investing for Beginners Guide series how gold was replaced by paper money. If that hadn't happened, when a government issues a bond, you would give it 1,000 gold coins and you would get 30 gold coins per year in interest. Gold supply grows at around 1 to 2% per year, and it cannot be created artificially. So the 30 gold coins you get at the end of each year would have roughly the same value as they did an year ago. And whatever the government does, it cannot simply create the coins to pay you back. However, we don't live in such a world. In the current world we live in, governments of the major world economies that have their own currency, like the USA or UK or Japan, are in complete control of the creation of new money, which means that if they don't have enough to pay you back, they can always print more. Remember when I said that if you invest in a bond of a major developed economy, you are guaranteed to get your money back, right? Well, this is one of the main reasons why. If you invest in a dollar bond of a country like Sri Lanka and they have to pay you back in dollars, but they don't have enough dollars because their economy doesn't produce enough to buy these dollars, they will go bankrupt. However, if you invest in a Japanese bond and the government has some issue paying it back, well, what they do is they can always print a bit more Japanese yen and give you back the money. And you will be glad you got it back, but by the time it gets to you, the value of the money would have already dropped because they had to print it. Now tell me this, would you lend money to an entity that had the ability to create at will the money they pay you back in? I certainly wouldn't. So basically what happens is through various methods which are too complex to explain in a beginner investing guide, all the major governments engage in what's known as financial repression. Financial repression is a term that describes measures by which governments channel funds from the private sector to themselves and thus they reduce their debt. The overall policy results in the government being able to borrow at extremely low interest rates, which would not be possible in a free market that doesn't have government interference. Of course, it happens at the expense of savers and investors who receive lower returns on their investments. How does that work? As I said, this is a complex topic, but I will give you a few brief examples. Let's say you are the government and under a free market you have to pay 5% interest on your bonds to investors. However, that 5% is higher than you can afford. So what you do is create rules and regulations for the pension system that forces it to invest pensioners' money in safe assets. Which are those safe assets? Government bonds, of course. And in that environment, the government, using its regulatory power, constantly funnels the savings of the pensioners to fund itself. The pensioners receive artificially lower 2% interest on their bond investments instead of the original 5% they should have. It's a sickening and silent way of confiscating private wealth to fund public spending, but that's the game we have to play if we want to invest in bonds. Another example is yield curve control and quantitative easing, under both of which the central bank creates new money to buy government bonds. That way, as a bond investor, you are literally competing with an entity that has unlimited amount of investing power and you are bidding against them. Not a great game if you ask me. And so, using all these measures, governments love to lower the returns on bonds below the inflation rate, which is also called negative real yield. It comes from the word yield, which is the interest of the bond. It is negative because it is below inflation. If the bond is yielding 2% and the inflation is 3%, you're losing 1% a year. And the government uses that 1% difference to slowly erode the amount of their debt by silently confiscating your money while you think you're making 2% income on your investment. But it gets even worse than that. Bond interest payments, unlike rent from real estate or dividends from stocks, don't grow. If you invest $10,000 in 2% yielding 30-year bond now, on the first year, you will make $200. And on the 30th year, when you get your last payment, you will still make $200. And then you will get your initial $10,000. If you know how much the value of your money has dropped in the past 30 years, you can imagine what it's gonna be in 30 years from now. Because of that and more, I personally don't like investing in credit instruments in general. That includes corporate and government bonds, because I refuse to play that game. I refuse to play the game of negative real returns and losing money to inflation, manipulated markets, and sneaky financial repression tactics. Obviously, I'm not your personal financial advisor and I cannot tell you what to do, but this is how I think and I'm sharing it with you. Alright, so how can we actually invest for passive income then without playing a game that is rigged against us? This is what we will discuss next. So click on the video that should have appeared on your screen and I'll see you there.